Hello, everyone. Thank you so much for joining us again for another weekly wrap-up. My name is Jeremy Cronemeyer, Operations Manager for Wickham Financial Group. And I have Graham Wickham here, President and CEO of Wickham Financial and Insurance Services. Graham, what happened in the markets last week?
Yeah, thank you, Jeremy, and thanks for our listeners jumping on the call. Yeah, I think we saw a little bit of a risk-off trade last week. So we saw the S&P and the Nasdaq, that was down just over 2%. In that Russell small cap area, really took the biggest hit. That was down about 4%. But we did see 10 of the 11 S&P 500 sectors declining. The one outlier, which was a gainer, were utilities. So in the tech sector, that was down about 2%, despite some really strong earnings, because remember, we're deep into earnings season, really more towards the end here. We had good earnings from Microsoft, Meta, platforms, Amazon, and Apple. We looked at some economic data. We saw the non-farm payrolls. July, it was positive 73,000 jobs. That was well below expectations, though. The prior month's revisions were downward, and we saw a 3 months average growth, just positive 35,000. The unemployment rate, that did stay pretty steady at 4.2%. In turn, we saw the U.S. dollar weaken after some payroll numbers came out. Treasury yields, they dropped pretty sharp with the anticipation that the Fed's maybe making the case for the Fed to be a little more aggressive, not to mention just lowering rates maybe more towards the end of the year. So staying with the theme of the Fed, we saw interest rates held steady at this meeting, but we did see two of the members, the FOMC members, really dissent. And that was the first time since 1993, citing some labor market risk, meaning if we're going to see increasing unemployment, does that mean that we need to lower interest rates quicker, faster, or more? So if we look at the June CPI inflation, the headline was a positive 0.3 month over month, with year over year at a positive 2.6%. But the core was pretty steady at 2.8% year over year. The new tariffs, they may be a challenge to the Fed's 2% inflation target, and that might be a bit of a case for Chairman Powell not wanting to be too aggressive on lower rates. I think really wanting to see how the tariffs end up playing out with the cost of goods and services as it kind of makes its way through the economy. So if we look at GDP and manufacturing, we saw Q2 U.S. GDP. That was a positive 3% annualized. That was better than expected. Well, it was boosted by trade and some reversal from the Q1 import deficit. Now, if we look at the ISM manufacturing PMI, that fell to 48. That was from 49. And the employment index, that was the lowest that we saw since June 2020. Now, keep in mind, we're saying that some of this stuff is coming down, but we still are seeing a reasonably good economy, strong consumer, and the market's holding into place because of that. We also have good earnings. If we look at the global central bank and those markets overseas, if we look at the Bank of Japan, they held rates pretty steady. Now, they raised their inflation forecast. They were a little less, they were less pessimistic in terms of their outlook, but they were also looking at a possible rate hikes later in 2025. If we look at the Bank of Canada, they held rates pretty steady, citing some U.S. trade policy uncertainty. Over in Europe, we saw Q2 GDP. That was a positive 0.1. That was better than expected, but still pretty weak. If we look at July inflation, that was steady at 2%. China, their manufacturing PMI signals some deeper contraction. Now, let's look at the week ahead. We look at volatility. That's going to remain probably pretty elevated throughout this week, since we had that pretty strong sell-off at the very end of the week last week. Some ongoing uncertainty around trade deals, tariffs, so on and so forth, and the Fed dissenters. Now, that was Waller and Bauman. They believe the Fed is being just too cautious. Tariffs have had limited price impacts so far, so their thought, not putting words in their mouth, I would just assume, is that why not go ahead and lower at this particular point? But we do see Chairman Powell suggest that the Fed may be looking through those goods inflation by not raising rates. Now, the market is still pricing in 2 rate cuts by the end of the year, mainly due to some labor market concerns. So maybe trying to get ahead of this, increasing unemployment that they're expecting might happen. Now, key U.S. economic data, we'll look at the Treasury auctions for 10 and 30-year bonds. The ISM service PMI numbers will be coming out. We'll look at factory orders, some preliminary Q2 productivity, unit labor costs, consumer credit data, and then the Fed's activity. It's going to be pretty quiet this week, but I think we really have Federal Reserve members coming out, speaking a bit this week, probably setting the tone on what the Fed may do or setting themselves up to do in the next meetings. And then again, it's still earnings. Listen, the majority of companies are coming out. I think it's 80% are coming out and beating expectations. That's great. I think the average is on, what, 75? So we're still looking at really good earnings. The tech sector has been posting some great earnings, but we got some notable companies coming out this week like Palantir, Advanced Micro Devices, Caterpillar, Uber, Disney, McDonald's. So we still have some pretty big names that come out. So we still got a little bit of ways to go, but we're seeing the majority have already out reported and the earnings are looking pretty good. And I think that's what's really supporting this market right now. We look at overseas. We got the Bank of England expected to cut rates by 25 basis points. Their decision may come in despite some inflation uptick. We look at China, the trade and inflation data will be due, and then we'll wrap it up with Bank of Japan releasing their summary of opinions. Jeremy?
Got it. Well, Graham, I had a question for you. So I guess historically, August and September seem to be a little volatile or whatever in the markets. Do you see that to continue this year and going forward?
Yeah, I do think so. I think that's a great statement and maybe a question in there. And yeah, I think it does. I mean, we came through a good bit of volatility in April when the tariffs were just announced at such high levels. The market bounced back dramatically. We've got good earnings. The market is trading up, meaning the indices all the way from the S&P, the Dow, the Nasdaq, the small cap area, in light of additional trade talks that haven't had resolutions completely yet. But the earnings are holding up. So I think the market has done quite well in light of all this. So I wouldn't be surprised to get more volatility into August through October, traditionally a bit more challenging, like you mentioned. So, the tip for our clients is, it doesn't always pay to watch every step in the market. Sometimes just look away, let things happen, own quality, stay balanced, and understand what your time horizon is and your risk tolerance. When you have that in place, you can ride out some of these bumps, and you got to expect them.
Gotcha. Well, Graham, we always appreciate the information, expertise, and thank you to our listeners. And we do have our first classes coming up for our retirement planning today. The first Saturday class is this Saturday, the 9th, and then the first Tuesday class is next Tuesday, which is the 12th. So if you're interested in those or have a family member or a friend that's interested, give us a call here at the office or check out our website, and we'd be glad to get you on there. And we'll look forward to seeing you next week.
Take care.